what you think 2024 looks like. Because we came into 2023, everyone was universally bearish. We were supposed to have a huge recession. 2022, for those of us who are building companies and were operating in technology, that felt like the depression. It was hard to imagine a scenario in 2023 that felt worse than the startup ecosystem did in 2022. I think in the beginning of 2023, it was a continuation of what we saw in 2022, but markets, especially on the public side, have rebounded quite a bit. S&P as of this taping is either at or near the year-to-date highs. Bitcoin is up like 180% this year. Even the NFTs, the altcoins, like the riskier assets are rallying. And I think a lot of people, both on the institutional side and the retail side, are sort of confused. On one hand, people don't want to miss some huge rally if we are going to go back to bull market, and on the other hand, no one wants to sort of be the sucker that buys this rip, and then we flip the calendar and things roll over and they get smoked. So how do you think things are setting up for 2024 on the equity markets to start?
Yeah, well, I think from a macroeconomic dynamic and environment, we if you just think about where we are in the cycle, that's what the macro people start with. Unemployment is at secular lows, which means we're late in the cycle. Nominal growth remains relatively elevated compared to what needs to happen in order for the Fed to durably meet its inflation mandate. And we've gotten a large effective easing over the course of the last month as a result of, in particular, the Treasury making a decision to limit bond supply in the market, as well as expectations that the Fed will swiftly cut interest rates in response to falling inflation in 2024. And so what you see in terms of that combination of dynamics is a late cycle, reasonably strong growth, like pretty good growth from a nominal perspective, paired with a recent easing impulse. The easing impulse is also supported by the falling gas prices, which are also effectively like an external easing that's occurring for the economy. That would typically lead in 2024, you'd expect on a forward-looking basis, for that to lead to continued economic strength, right, in the market, right? So a pretty good environment until we get a sufficient amount of tightening to really put the brakes on the economy. And so that's kind of where we stand today. And what I'd emphasize is then you have to compare that. If you're trading macro markets, you have to compare that picture, what's happening today, what's likely to happen with the macro economy, with what's priced into the asset markets. And what we see priced into the asset markets is 150 basis points of cuts by the Fed in 2024. There's in fact a greater than 30% probability of more than 200 basis points of cuts in 2024 priced into the short rate market. So a lot of easing priced into the market. Whenever you're trading financial markets, what you have to really do is you have to compare that perspective, that outlook of what's likely to transpire with the macroeconomy. You have to compare that to what's priced in to the asset markets. And what's priced into the asset markets right now is 150 basis point cuts by the Federal Reserve over the course of 2024. And that's would be surprising in the context of relatively strong growth in a late cycle economy. Typically that would lead to continued tight or tightening policy. And so that gap is likely to put pressure on, in particular, the short rate market and the bond market. And you can sort of see some of that dynamic playing out actually today as we record this, when a hot unemployment report was just printed earlier in the morning. I think for stocks, the picture is a little mixed, which is that stocks from a valuation perspective are at all-time highs, and relative to other assets, they're very, very expensive. They're at 30-year highs relative to other assets. What's priced into stocks, or the expectations of stocks, are continued relatively strong growth on a nominal basis. What we're talking about here is that we're likely to see relatively strong growth, but the problem is if we get that pressure in the bond market, we're likely to, with bond yields moving up and more tightening than expected, we're likely to see a shift over time to stocks taking a hit from those rising rates. And so we're more in an overall dynamic likely to be moving back towards what I'd call the higher for longer and really the high for longer environment.